In this topic, we continue our discussion on price-earnings ratios and start by looking at them for broad-based market indexes in the US and in India. We also mention other metrics for comparable valuations and conclude with a special case of one company that I know you know quite well. The Shiller PE is the gold standard for determining a price-earnings ratio for a company or for a market. It is also known as the cyclically adjusted PE or CAPE, and it does average out earnings over the past 10 years for the business cycle and also adjust them for inflation. If you recall, we had talked about this in the previous module on this topic. Figure 1 shows you the pattern of these PE ratios for S&P 500 firms in the US since 1880. Notice how they fluctuate. A level of 30 times earnings during the depression of the 1930s before markets crashed and prices fell. An even higher number of 40 times earnings before the internet bubble of the 2000s burst. And low as the teens during the financial crisis of 2008 and 9 when US stocks were really cheap. These PE ratios would be at much higher levels than displayed in the chart if current earnings were used instead of the cyclical and inflation adjustments that are made in the CAPE. Figure 2 shows our efforts for the last decade. The numbers are a little different, hovering around 20 for the last 10 years or so. One conclusion from this, of course, is that maybe Indians seem to be willing to pay higher prices for each rupee of earnings than in the US. But as you know, with everything else, you have to be careful. Are earnings estimated the same way in both countries? You may have heard or read about IFRS, or International Financial Reporting Standards, which are a global effort to bring about some amount of comparability to accounting standards around the globe. While that IFRS discussion is beyond the scope of this current topic, at least these two figures, CAPE for the US and CAPE for India, permit you to get a sense of what levels of price earnings can be deemed as expensive and what levels as cheap. In investment practice, comparables often take the form of selecting accounting variables from a profit and loss statement to compare with the market price instead of just the earnings number from the bottom of that P&L. One such metric is the price-sales ratio. Sales, of course, is at the top of the P&L. The second metric that financial analysts in India and elsewhere like to use is the price-to-EBITDA ratio from the middle of that P&L in order to get an estimate of the value of stocks. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It represents the earnings from a company's core operations before financial adjustments like taxes, depreciation, and interest are taken out. Capital-intensive firms in some industries may carry a lot of debt on their books, which they are allowed to deduct before taxes. This affects the bottom line earnings number, so it may make more sense to look at an operating number instead, which is what EBITDA is supposed to be. I've mentioned my travails with Amazon as a stock elsewhere, so it shouldn't surprise you that I bring it up again. In brief, Amazon went public in 1997 at about $18 a share, split 2-for-1 in '88, and then split twice in 1999, 3-for-1 in January, 2-for-1 in September. This means basically that one share bought at its IPO would now be 12 shares. The float for this company has been about 400 million shares since then. Recall from a valuation standpoint that this company started out wanting to sell books and CDs online and videos too. While their revenues were growing, they didn't report positive earnings until 6 years later, about 2003. Very few then had a sense of how big this company would become, except perhaps Jeff Bezos, its founder. I want to talk you through an actual comparable valuation conducted by a very respected Wall Street analyst as long ago as 1999. He was making a forecast for Amazon's stock price 5 years from then out to 2004. Here's how he started. The world market for books, CDs and videos at the time was like 100 billion. His first comparable metric was to assume that Amazon would get 10% of that 100 billion so its market cap would be $10 billion. That 10% came from a comparison with Walmart, a then powerful competitive retailer. His second step was to take that revenue number for Amazon of 10 and try to apply a profit figure to it. 3% retail profit margins are what are common in the West. This guy assumes a comparable of 7% like Dell for Amazon. So that earnings number comes out to be 700 million. 2 steps, he jumps to earnings from the top of the P&L to the bottom of it. All he needs to do next, now that he's got an earnings estimate, is to hit it with a PE ratio and you've got a target price. So he starts with a third comparable. Slow growth firms in the US have price earnings ratios of about 10. He expects that Amazon, being a high growth firm, will have a PE of 75. Sounds strange and high today, but this was 1999. At the time, the internet ruled the world and was going to continue to rule it. So PEs of 75 were permitted. So based on that estimate of PE, his target market cap for Amazon was earnings of 700 times a PE of 75 to get a market cap of $52.5 billion. So compared to this estimate of market cap of $52.5 billion, the actual market cap in 2004 was roughly half that, at $25 billion. This was an optimist analyst, you would think. 15 years later now, the current market cap is closer to $1 trillion US. This stock went stratospheric recently. India has been one of their biggest growth stories. But my message is a powerful one for you to think about in terms of comparable valuation. Notice the types of peer comparisons being made. Best of breed retailers like Walmart, offline, Dell, online. Notice also the PE estimate of fast-growing firms at 75. This was 1999. Internet companies were the rage. The analyst is a creature of the time too. And in conclusion, I hope you recognize that these somewhat casual analyses are just the tip of the iceberg when it comes to valuing stocks and thinking as a long-term investor. I hope you will come back to our site for more. Thank you.